Welcome to Get Rich Education. I'm your host, Keith Weinhold. Debt, inflation, and interest rates are substantial factors for any real asset investor's portfolio returns. They're largely driven by macroeconomic forces. It's a big picture national and international chat today with Jim Rickards. How will you be positioned in what he calls the financial aftermath? Today on Get Rich Education. Countless property investors get killed with maintenance costs, but that's far less likely when you buy brand new construction. Let me tell you about JWB Real Estate Capital in Jacksonville, Florida. They pioneered the build-to-rent model where you can invest in new construction, turnkey rental properties. That's why JWB was featured on the front page of the Wall Street Journal. To learn more and see inventory, go to newconstructionturnkey.com. Finally, Total Control Financial gives you checkbook control of your 401k and IRA money to invest in real estate. It's time to get your retirement money into your own checking account, but you've got to avoid the little-known tax that you'll pay with any self-directed IRA. Instead, it's time for the QRP. Learn more and get your free copy of the QRP book by text messaging QRP in all capital letters to 72,000.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, episode 253. I'm your host, Keith Weinhold. This is Get Rich Education. Interest rates, debt, and inflation affect you as an investor and just as an everyday layperson. Fees are driven by more national and international forces than what happens at your local level. For example, one big reason that the Fed announced lower interest rates 12 days ago, their first cut since 2008, by the way, is to try to get higher inflation. And, I'm often reminded about how few people think about the diminished purchasing power of the dollar. Recently, I met an older couple from Tulsa, Oklahoma. I got talking to the husband about real estate, and he mentioned that he recently sold the home that they had lived in for 30 years. And then he told me in a proud way that he sold the home for twice as much as he bought it for. And as soon as I heard that, I immediately kind of thought, what you talking about, Willis? Doubling your money in 30 years, that might be an inflation-adjusted loss, because the dollar surely could have lost more than half of its purchasing power in that time, not to mention all those monthly payments that he made on the house. Primary residences are negatively cash-flowing vehicles. My home that I live in was purchased 7 years ago for $470,000. And due to a local recession in my area, it would only sell for about the same $470,000 today. When a neighbor and I were having a discussion about our neighborhood, and I mentioned that my home would only sell for the same price today that I bought it for 7 years ago, his response was like, well, Keith, at least it held its value.
What you talking about, Willis?
Yeah, again, what you talking about, Willis? We've probably had at least 20% total inflation in these last 7 years since I bought the home. So the price of my home is the same, but yet the value is 20% lower. Same price, less value. That also means that housing is more affordable in my market than it was 7 years ago. So most people aren't thinking about inflation. Today, I will ask our guest, Jim Rickards, about how, when you're positioned in real estate, how would you fare in this so-called aftermath, the title of his new book? And the aftermath he describes probably won't be so much that people won't have clean drinking water and they're all going to die of malnourishment, but rather a new monetary order. He'll tell you that Trump tax cuts were not a good thing. They were not done in the right way, more specifically. And the fact that the United States now has a debt to GDP ratio of 103% is a real problem because there's a critical inflection point at 90% is what he'll tell you. Let's ask our guest about it. Today's guest has served as an advisor on international economics and financial threats to the U.S. Intelligence Committee and at the Office of the Secretary of Defense in the Pentagon. He also has 35 years of experience working in capital markets on Wall Street. Today, he's the editor of the publication Strategic Intelligence. He lives in New Hampshire. He's the multiple New York Times bestselling author of very popular books that you very well may have read, like The Road to Ruin, The Death of Money, Currency Wars, and The New Case for Gold. I want to talk about his brand new book. It's called Aftermath, and it's subtitled 7 Secrets of Wealth Preservation in the Coming Chaos. Welcome to Get Rich Education, Jim Rickards.
Thank you, Keith. It's great to be with you.
Jim, I've had an advanced copy of your book, Aftermath, and it shows how and why our financial markets are being artificially inflated and what everyday people can do to protect their investment assets and themselves. But tell us about the overall thesis of Aftermath.
That's a great question. I had this discussion with my editor at Penguin Random House. It has 8 chapters and a conclusion. And she says, Jim, I love your writing. I love these chapters. But where's the thread? Where's the connecting element that makes it a book and not just a collection of essays? And that connecting element is one, debt, which is that I'm not talking about money you might borrow to buy a piece of property or whatever. That's fine. That's consumer debt. But really the national debt and the equivalent around the world and what that's doing to grow. So that's a big part of the analysis. The other thing is the warning signs of another financial collapse. And I'm not saying it's going to come tomorrow, and I'm not saying it's the end of the world, but you can see it coming. These things happen with some regularity. You go back, the stock market fell 22% in one day on October 19th, 1987. That would be the equivalent of maybe 5,000 Dow points today, not 500, but 5,000. 1994, the Mexican crisis. 1997, the emerging markets crisis. 1998, the long-term capital management Russia crisis. 2000, the dot-com collapse. 2007, mortgages collapsed. 2008, a global liquidity crisis. So to say that these things don't happen or can't happen is nonsense. The history shows they happen with some regularity. It's been 10 years since the last one. When will the next one come? Well, no one knows exactly. I don't know exactly, but there are warning signs, and that's really the point. So the combination of debt as the big warning sign and a number of other elements, automated trading, robot allocations, passive investing, instability in the international monetary system. These are all signs that are out there. They're in plain sight, but they should warn investors that another collapse greater than 2008 is just a matter of time.
You bring up some of those points in your book. When people think about a recession or a depression, for most people, it's just what's in the recent memory. And that was the awful scenario of 2008 and its aftermath. But you bring up in your book, in the Great Depression, stock indices fell 80% in 3 years. In the Civil War, the Southern economy was decimated. It didn't even recover until the 1970s, more than a century later. And with the Dust Bowl and some of the other problems, these things really recur more often than what some people think. And a lot of the thesis of your book kind of revolves around debt. Now, if you go to usdebtclock.org, you can see right now that the United States national debt is $23 trillion. Relate that to what that really means to the everyday person somewhat. That's $68,000 per citizen, but it's $183,000 per U.S. taxpayer. And some people, Jim, say, well, what's wrong with continuing to inflate our debt? I don't seem to be living inside any problems. Why can't we just keep kicking this debt can further down the road and further down the road and further down the road like we have, whether it's been with quantitative easing cycles or artificially low rates? Why can't we keep kicking the debt can down the road?
Well, you're right, Keith. A lot of people do say that and do ask that question. But let's just step back a little bit when we talk about the amount of debt. Your numbers are right, of course. It is $23 trillion. But you cannot analyze debt, whether it's a problem or not a problem, without comparing it to the capacity to pay the debt or manage the debt. Basically, your income in the case of an individual or GDP in the case of a country. So let's just take a simple example, but it proves the same point. So say you have a credit card and you have $25,000. That's the balance on your credit card. That's how much you owe.
Right.
Is that a problem or not? Well, it depends how much you make. If you make $20,000 and you got $25,000 on your credit card, you're probably headed for bankruptcy court. But if you make $500,000 and you have $25,000 on your credit card, you can probably pay it off with one check. You can't form a judgment as to whether debt is a problem or not without comparing it to the capacity to manage the debt. In the case of a country, that's GDP. So to me, the relevant statistic or the relevant metric is the ratio of debt to GDP. And where does that stand? And a lot of people kind of naively assume that, George Washington became president in 1789 and we didn't have any debt, and he borrowed some, and Thomas Jefferson borrowed more, and so on all the way through U.S. history, and the debt kept going up and up and up, and we are where we are today at $23 trillion. That's not true. That's not what happened. We had national debt before George Washington became president. When he was sworn in, we already had a national debt left over from the Revolutionary War. And the question was what to do with it. And the Congress said, well, that's easy. Let's just default. We don't have to pay it. That's kind of the American way. And it was Alexander Hamilton who stood up and said, no, what we need to do is borrow more money, pay off the old debt. Then we'll have good credit. Then we can borrow more money, pay off the new debt, and just keep it going, keep rolling it over. And that's what we did. That was the origin of the U.S. government securities market, the U.S. Treasury market. And it's been going strong for 230 years. But the debt did not just keep going up in a straight line. What actually happened is the debt would go up, and then it would come down, and then it would go up, and then it would come down. So it's more like a sine curve or a wave. And what was the dynamic behind that? Why did it increase and why did it decrease? Generally speaking, there's a very high correlation here. Debt increased in times of war. Wars are existential where they're critical and you borrow money to fight the war, but then you win. And then you pay down the debt. Debts would go down in times of peace. So this, what I call a sine wave, up and down, is the actual path of debt. And actually as late as 1836, during Andrew Jackson, the end of Andrew Jackson's administration, there was no national debt. Andrew Jackson actually paid off the national debt. He also abolished the central bank at the time, so we had no central bank between 1836 and 1913. Did just fine, by the way. But the point is, Jackson was the last president to erase the national debt. But obviously it went up in the Civil War. But here's the point. At the end of World War II, the debt to GDP ratio, and that's the critical metric I'm talking about, was 120%, the highest in U.S. history. But you can sort of look at FDR and say, well, you had to fight the Great Depression. That was kind of a financial war. And then you had to fight World War II, which was a real war. And so we understand why the debt got so high. But then over the next 40 years, through Republican and Democratic administrations, on a bipartisan basis, through 1981, so the end of Jimmy Carter's administration, they got that debt to GDP ratio down to 30%. So they started at 120% and they got it all the way down to 30%. But it was bipartisan. It was Republicans and Democrats working together. So you had Democrats like Harry Truman, John Kennedy, Lyndon Johnson, and Jimmy Carter. But you also had Republicans like Dwight Eisenhower, Richard Nixon, Gerald Ford. And together, they got it down to 30%, which is very manageable. That's not a high debt load for a country like the United States. Now, Reagan comes in, and there's this notion that Reagan was this fiscal conservative. It's not true. Reagan was a big spender. He took the debt to GDP ratio from 30% up to 50%, but he won the Cold War. So it was a big debt increase, but he built a 600-ship Navy and Star Wars and a lot else. And we got something for the money, which is we won the Cold War. We defeated the Soviet Union, which officially dissolved on December 25th, 1991. So you can cut Reagan a little bit of slack there. I mean, David Stockman got fired or run out of town by Reagan for criticizing the debt. And Stockman was right about the numbers. But I think he missed a bigger point, which is, okay, we won the Cold War. But then under this historical pattern I've described, what should have happened is the debt to GDP ratio should have gone down again. That didn't happen. Now, George H.W. Bush and Bill Clinton, again, one Republican, one Democrat, they kept a lid on it. It didn't go up. The 50% that Reagan gave them went up a little bit, maybe a little closer to 60%, but they kept it in that 50 to 60% range. It did not explode, but they didn't get it down either. But then when George W. Bush 43 came in, that's when the whole situation really ran off the rails. Bush doubled the national debt from when Clinton left, it was $5 trillion. Bush doubled it to $10 trillion. But then Obama comes in and doubles it again from a higher level to $20 trillion. So imagine the entire history of the United States from George Washington to Bill Clinton. We got $5 trillion of debt. But by the time Obama leaves office, we have $20 trillion of debt. And by the way, Trump has added a couple trillion to that. So we're up around 22, getting close to 23 trillion at this point. So this breaks this pattern I described where it goes up in wartime. Yes, we understand why. And it goes down in peacetime through bipartisan efforts. That's no longer the case. It used to be both parties, Republicans and Democrats, where there was bipartisan responsibility. Today we have bipartisan irresponsibility where Democrats and Republicans are saying there's no limit on basically how much debt you can have. So now we're in a danger zone, and this is quantitatively defined. There's a lot of good research to back it up from Ken Rogoff and Carmen Reinhart, two very prominent economists, that show that up to 90% debt to GDP, you can still get a little juice for your money. Certainly at low levels, running some debt can increase aggregate demand, as John Maynard Keynes described, and give the economy a little boost. But once you get past 90%, you're in the red zone. And now more borrowing does not give you more growth. In fact, it can actually, you can borrow $1 and get 90 cents of growth. In other words, you don't even get $1 for $1 of borrowing and spending. You get less than that. So that's where we are now. And that's one of the problems with the economy, which is that we're not growing fast enough to cover the increase in the debt. Instead of the economy growing faster than the debt, which is manageable, we have the opposite where the debt is growing faster than the economy. And not only does that sort of put you on a path to a crisis, but it actually slows growth. And everyone's like, well, gee, when's this big debt crisis going to happen? That you lose confidence in the dollar, we have hyperinflation. It could happen. You can't rule that out. But there's a more subtle crisis underway, which is that we are just not growing fast enough. And this debt to GDP ratio keeps going up. And the economic growth is, we're not in a recession, at least not as far as we know, but we are in a depression defined as depressed growth. If potential growth is 3.2%, which it is, and if actual growth is 2.2%, which it is, you have growth, but it's depressed growth. Japan's been going through this for 30 years. And right now, the U.S. looks a lot like Japan.
Yeah, that's right. And we know with Japan and Sweden, their negative interest rate experiments really didn't work to help get them out of their debt crisis. So you've identified this 90% threshold. That's really the point at which you can no longer borrow your way out of growth. 90% debt to GDP ratio. That high debt impedes that growth. Why does high debt impede growth? Why is there that inflection point there?
Well, there are a couple of reasons for it. Number one, when you look at debt ratios that high, people aren't stupid. They may not all be PhD economists, which is probably a good thing, but they certainly look to the future. They say, well, how are you going to get out of this? Well, one way is higher taxes. And by the way, a lot of the presidential candidates are talking about higher taxes. They don't really want to reduce the debt. They want to spend more. But either way, people look at it and say, well, we're not growing fast enough. The debt's going up. The government's going to have to tax us more. That tends to be deflationary and recessionary. What do people do in deflation? Well, they spend less. They save more. By the way, that's why negative interest rates don't work. The eggheads, the economists say, well, if zero interest rates are stimulative, negative interest rates have to be more stimulative. That's not true. That's an academic theory. But in the real world, what happens is, a negative interest rate. So let's say you have 100,000 in the bank and interest rates are negative 1%. Well, you go away for a year and come back, you've only got $99,000 in the bank.
You have to pay the bank to park your money in negative interest rates.
Correct. They take the money out of your account. Well, the economists say, well, since we're taking your money, it just makes you want to spend it. We'll get lending and spending. We'll get more inflation. We'll get the economy growing, rocking and rolling. No, that's not true. It's the opposite. People say, well, I'm saving for a reason. I want to buy a house or my own retirement or my parents' health care, or my kids' tuition, whatever it might be. And if you're taking money away in the form of negative interest rates, I have to save more, spend less, save more to make up the difference. So you actually get you don't cause inflation and spending at all. What you cause is more savings, a bigger liquidity trap, more deflation, and a slower economy. So take negative interest rates off the table. They don't work at all. And you're right, Japan, Sweden, but also Europe. The European Central Bank has negative rates, and they've shown that they don't work. So zero means zero. You can cut interest rates to zero, but at the zero, what's called the zero bound, that's it. You're not getting any more benefit out of interest rates. Now you have to go back to QE, whether it's QE4 or QE5. We're not in quantitative easing today, but the central bank, the Federal Reserve would like to get ready for that because they may actually have to do that. So the bottom line is you're not getting any bang for the buck in more borrowing because people are looking at it, assuming taxes will be higher, assuming deflation will be worse, and they're just saving more. They're not spending the money at all. And by the way, if you slip from disinflation, which we have now, to deflation, what happens to debt? Well, the real value of debt goes up. I mean, you might owe $2 million, but in a deflationary environment, that $2 million gets harder and harder to pay. Real estate people and people with high debts, they root for inflation. Well, that's understandable because that makes the debt easier to pay and sends the asset value up.
100%.
But deflation is the opposite. Deflation sends the asset value down and the real value of the debt goes up. So real estate investors don't like deflation. I guarantee you central banks don't like deflation. Nobody really likes it, but that's what you get when you have these policies we've seen over the last 9 years. So it's a real danger. But the bigger danger is the one we mentioned at the beginning of the interview, which is that the national debt, the debt to GDP ratio, is now at the point where it changes behavior and just makes the situation worse.
Now, in the book, Aftermath, you have outlined a few solutions there. Inflation is one of them, which you've already mentioned. Perhaps the United States could use growth and grow their way out of the debt by developing a new technology or innovation and help increasing our GDP that way. Taxing our citizens to a higher degree is something that might help put some downward pressure on that. And the other one is probably the most politically unpopular at all, potentially, if it's not inflation, and that is defaulting and just walking away on the debt. I know one of those potential solutions is higher taxes. You stated that Trump's tax cuts will bury economic growth under a mountain of debt and shake world confidence in the U.S. dollar.
Sure. The Trump tax cuts were a huge mistake. Not tax cuts per se. Tax cuts per se can be very healthy, but it depends how you structure the tax cuts. What Trump did, they basically favored wealthy individuals and corporations. So just take a couple things that were said at the time. This became law at the very end, almost midnight, New Year's Eve, just about December 2017. But it didn't really take effect until 2018. And we're just now beginning to see some of the consequences of it. So what did they say? They say, well, we're going to cut corporate taxes. This will give corporations more after-tax money, and they'll use that for investment and plant and equipment. That'll help GDP. It'll create new jobs. That'll help GDP. We'll all live happily ever after. That is not what happened. And I said so at the time. I said, that's not going to happen. And it didn't. What the corporations did with the money is they did stock buybacks. Okay, that's good for stockholders. It pumps up stock prices, but it does nothing for investment. And it's a short-term pop. It's not something that's sustainable. The other thing they said was that, we have all these trillions of dollars of earnings overseas in offshore subsidiaries in Ireland and the Cayman Islands, corporations like Apple, et cetera. And when we reduce U.S. taxes and give you a one-time tax benefit on foreign earnings, this wave of foreign earnings will come back to the United States, and that will be a source of investment, new jobs. And that was nonsense. You have to understand the tax system. By the way, before I got into securities law, I spent the first 10 years of my career as International Tax Counsel at Citibank. So I know a little bit about how all this works. First of all, the money was always here. It might be on the books of an Irish subsidiary, but it's not like they had a big pile of dollar bills buried under the Bank of Ireland. The money was invested in U.S. markets, in U.S. treasuries and money markets and other instruments, none of which subjects it to taxation. Foreign corporation that invests in U.S. securities does not have to pay U.S. tax on that. So the money was always here. So the notion that there was a wave of money returned to U.S. markets was nonsense because it was always here. All you had was a bunch of accounting entries where you took it off the books of the foreign subsidiary, put it on the books of the U.S. subsidiary, reversed the tax provision. You had provided higher taxes. Now you could reverse your deferred tax reserve, which increased your earnings per share. So again, it was a boost to wealthy stockholders and corporations, but it did nothing for investment. Do you think 5 years ago, if Apple had wanted to build a plant in the U.S., they couldn't have borrowed money at 1%, $10 billion, pledged the cash as collateral and built the center and created the jobs? They could have done that any time.
Yeah.
It had nothing to do with the tax bill. So the tax bill was mostly a fraud that benefited wealthy corporations. If you want to cut taxes and help the economy, reduce the Social Security tax 50% or 100% for everyone making less than $70,000 a year. That'll boost the economy because the marginal propensity to consume is high. People take that money and go out and spend it. That's helping everyday Americans and helping to get the economy moving. That's not what they did. So it was pretty easy to look at the Trump tax bill and say, yeah, okay, this will boost the stock market. It's a one-time high. It helps the wealthy, but it's not sustainable and doesn't do anything for the economy. And that's exactly what's happening. You had this, people talk about the squad. Well, the squad around Trump was Art Laffer, Steve Morse, Steve Forbes, and Larry Kudlow. I thought they should hand out pom-poms, because they were all cheerleaders for this tax cut. And they said, we promise you 3% growth, 4% growth. This is Ronald Reagan revolution all over again, et cetera. And they were wrong in 1980 because the thing that drove the economy under Reagan was big spending. That's what drove it, not the tax cut. We were coming out of a severe recession. You're supposed to get good growth, which we did. But in today's environment, when they were doing the same cheerleading, a completely different environment. The debt to GDP ratio, as I mentioned, had gone from 30% to 106%. The national debt had gone from a few trillion to 22 trillion. We were not coming out of a recession. We were in the 10th year of an expansion. Labor markets did not have slack. They were tight. Everything about the economic conditions was completely different than when they tried this playbook in the early 1980s. And so no reason to expect good result as we got then. That's exactly what happened. In the first quarter of 2019, first quarter of this year, growth was 3.1% on an annualized basis. And Kudlow's out there and everyone's high-fiving. See, we told you it was going to be 3-4%. We delivered on our promises, et cetera, et cetera.
Dad introduced a lot of optimism.
Yeah, well, guess what? The second quarter is over. The estimate right now is 1.4% for the second quarter. So take 3.1 and 1.4 and average it. And guess what? You get 2.2 for the first half, which is the same punk growth we've had since June 2009. By the way, Obama had some 4% quarters. He had one quarter that was almost 5%, and he had a couple of quarters back to back where it was 4% back to back. So that happened under Obama, but every single time it collapsed. It went back down to 1%. All those 4% quarters under Obama, there were 4 or 5 of them in 8 years, but every one of them was followed by a collapse where it went back down to 1%. And the annual rate was like 2.2%, like clockwork. And when I saw the 3.1% number for the first quarter, I said, well, nice going. That was a good quarter. But my expectation is that the second quarter will collapse and we'll be back to 2.2% annual growth. And that's exactly what's happening. So no evidence that the Trump tax benefit is sustainable. No evidence that it's helping everyday Americans. The debt is still going up faster than growth, and we're getting into a deeper hole. Now, it doesn't mean the end of the world. I'm not saying that. It doesn't mean a recession. I'm not saying that. I'm saying that nothing has changed. Now, it may be good enough to get Trump reelected, but it's not 1984 again. It's not happy days are here again. So when you have this problem, Keith, where the debt is going up faster than the economy, and that is the case, there are 3 ways out of it, and you referred to them. One is growth. Like if we could get some growth going, maybe we could grow faster than the debt, and then the ratio would go down. The other one is inflation, which is if you have inflation, the real value of the debt goes down. So your economy, your nominal growth is high enough, but it's not all real. A lot of it's inflation, but so what? I mean, debt is nominal. So you need growth. You need nominal growth to pay nominal debt. And if it happens to have a big inflationary component, so what? I mean, that's not good for savers or people relying on steady streams of income, but It works. And the third choice is default. Well, we're not going to default because we can print the money. So there's no reason to default.
I agree.
In debt where you can print it, you'll just print it. So that leaves growth and inflation. Well, I already explained that with our high debt to GDP ratios and no change in economic policy, we're not getting the growth. We're getting some growth, but not enough. So there's only one way out of this, which is inflation. But here's the problem. The Fed has been trying to get inflation for 8 years and they can't do it. It's a kind of a sad day when the central bank wants inflation and can't get it. But that's the situation we're in. The Fed has an inflation target of 2%. They've only hit that briefly once in the last 6 years. And the last time it hit 2%, it turned right around and went back down 1.8. And right now it's at 1.6. So even with, almost $4 trillion of money printing and zero interest rates for 6 years, they couldn't get inflation. Why is that? Well, the answer is that inflation has nothing to do with money supply. All the monetarists and the Austrians completely missed the point. Inflation is psychological. It's behavioral. It's when people lose confidence in the dollar and they say, get me out of here. And they go out and say, I'll take anything. What do you got? Land, houses, gold, silver, fine art, oil, natural gas, water, anything. I'll buy a new car, but just get me out of the dollar.
Inflation is like a hot potato in the hands of consumers and they just want to get rid of it. It's like a piece of melting ice in their hand.
Correct. And so that is a psychological change.
Yeah.
And that could happen very quickly. And it did happen very quickly in the late 1970s. Right now, it's not happening. So the big question is, what is out there that will change consumer psychology in such a way that instead of the dollar being something you want to accumulate and pile up, it becomes something that you want to get rid of? We're not there yet. And deflation is a bigger problem today than inflation. But it could happen very quickly. And maybe our friends who believe in modern monetary theory will help us along there, because I think that will be one of the consequences of MMT.
What does an economic aftermath look like? We're going to talk about that next. You're listening to Get Rich Education. Our guest is Jim Rickards. More when we come back. I'm your host, Keith Weinhold.
Since 2014, the powerful Get Rich Education podcast has created more passive income for people than nearly any other show in the world. This show teaches you how to earn strong returns from passive real estate investing in the best markets without losing your time being a flipper or landlord. Show host Keith Weinhold writes for both Forbes and Rich Dad Advisors and delivers a new show every week. Since 2014, there's been millions of listener downloads in 188 world nations. He has A-list show guests include top-selling personal finance author Robert Kiyosaki. Get Rich Education can be heard on on every podcast platform, plus it has its own dedicated Apple and Android listener phone apps. Build wealth on the go with the Get Rich Education Podcast. Sign up now for the Get Rich Education Podcast or visit GetRichEducation.com.
Would you like to know the easiest way to create wealth and passive income with real estate? This is Marco Santarelli with Norada Real Estate Investments. Now you can access the best deals without the stress or hassle of having to find, renovate, or manage those properties. We save you time by providing you with passive income investment properties in some of the best U.S. markets. Learn more by downloading your free copy of The Ultimate Guide to Passive Real Estate Investing. There's no obligation and nothing to buy. Simply visit PassiveRealEstateGuide.com and get your free copy today. That's PassiveRealEstateGuide.com.
For a real estate investor like you seeking an income property loan, go to Ridge Lending Group, NMLS 42056. Over the years, you've heard President Chaley Ridge generously devote her time to you here on the show as a guest. Ridge provides investment property loans in most U.S. states, and you're going to find out how they've helped more people realize their dreams of real estate financial freedom than any other mortgage lender in the entire nation when you get started at ridgelendinggroup.com.
This is Richard Duncan, publisher of Macro Watch. Listen to Get Rich Education with Keith Weinhold, and don't quit your daydream.
Welcome back to Get Rich Education. We're talking with Jim Rickards. He's just published the new book, Aftermath. Jim, with these problems that are on the horizon, if they're not on the horizon, they're imminent, they're very close to us, as you state in your book. Potentially, we could have a new international monetary system. Tell us about how that would unfold and how that would look and how we get to that point.
Sure, Keith. And that goes to the title of the book, Aftermath. People say, well, what does that mean? Well, it has two meanings. One is we are still in the aftermath of the 2008 financial panic. I know it's 10 years later, 11 years later, we've had an economic expansion. I understand all that, but we haven't fixed the problems that existed then. And the debt problem's worse. Growth is below trend. We already talked about all that. We don't need to go over that ground again. But I do make the point that we're in a long-term, slow growth, high debt aftermath of the panic of 2008. But I also make reference to the aftermath of the next financial crisis and the potential for new international monetary system. And why don't we take those separately and talk a little bit about the international monetary system?
Yeah.
So the point I make, in 1944, a convening power, which was the United States and the UK, invited delegates from all over the world, and they went to Bretton Woods, the Mount Washington Hotel in New Hampshire. I'm going there next week, by the way, for the 75th anniversary of Bretton Woods. Be speaking at a conference convened by Peter Thiel, who's the founder of PayPal, and Larry Summers will be there. Kind of an interesting get together. But the point is, you could convene an international monetary conference today, and I've spoken one-on-one to Ben Bernanke, former Fed chairman, and John Lipsky, former head of the IMF. Separate conversations, one in Asia, one in New York, and they both used the same word to describe the international monetary system. They told me it's incoherent. And what they meant by that was there's no anchor. Like, I could tell you what the dollar is in euros or yen or whatever, but there's no anchor that you can measure all currencies against. Of course, that's exactly what gold and other hard assets can do.
Right.
But so you could have a conference. I call this is chapter 6 in my book, Aftermath. I call it the Mar-a-Lago Accord. The notion being that Trump could convene such a conference. Mar-a-Lago would probably be a great location for it. It doesn't have to be there, but you can envision it happening there. And sit down. It might take 6 months, or you wouldn't make it an overnight kind of thing, but you could actually work together. And whether it's SDRs, that's the special drawing right, that's the IMF's world money, or gold, or some hybrid, or something new, you could come up with a new international monetary system that did have an anchor. Do it in a rational, considered way. That's one path. The other path is do nothing, let the system stumble along, have another financial crisis, which is just a matter of time, and then have to do this on an emergency ad hoc basis, which is much more dangerous, much more potential for things to get out of control fast before you can fix it, or you make mistakes in the process of fixing it. And what I say is I recommend the former, but I expect the latter. In other words, sure, it would be better if we did this proactively and rationally at the call of someone such as the President of the United States and President Xi of China.
No, we won't do it unless there's a crisis.
We won't do it unless there's a crisis, and we'll do it wrong because that's what happens in a crisis. But I do lay out several paths. One of them is, by the way, I spoke to Tim Geithner about this, former Secretary of the Treasury. And I said, I don't think the Fed's going to be able to bail out the world again because they never normalized their balance sheet. He kind of agreed with that. It's one thing to take the balance sheet from 800 billion to 4 trillion, but can you take it to 5 trillion, 6 trillion, 7 trillion without destroying confidence? And we agreed that there's a limit there and you can't do that. And legally you can, but it won't work behaviorally. Then I mentioned SDRs. I said, well, if the Fed can't bail us out, how about the IMF? They have a clean balance sheet. They could print 1 trillion of these special drawing rights, hand them out to the members. That would reliquefy the world. A little bit to my surprise, Geithner poured cold water on that. He said, well, the IMF is slow. It's hard to get consensus. We tried it in 2009, which they did in a small way, and it just doesn't work. And I said, well, if the Fed can't bail us out and the IMF can't bail us out, how are you going to deal with it? And he told me, and I talk about this in chapter 6, so you'll find an explanation of that, or at least how Geithner sees it. Geithner is part of this global international monetary elite, so I think his views are the distilled wisdom of the elite, not just one man's opinion. So I also talk about crypto gold. I'm not a big fan of cryptocurrencies. I don't think much of Bitcoin, but what if you had a new one sponsored by Russia and China on what's called a permissioned ledger? And it's just blockchain, but blockchain for members only. So not anyone can start a Bitcoin mining operation or transfer Bitcoin. But what if we say we have a proprietary system and you can only use it if we let you in? That's a permissioned blockchain. And with a crypto linked to some store of value at a fixed level backed by gold. Then you get into the fact that Russia has more than tripled its gold reserves in the last 10 years. China has more than tripled its gold reserves in the last 10 years. Both countries have gone from about 600 tons to at or slightly over 2,000 tons. Why are they buying all that gold? Are they stupid, or do they see something coming that most people don't? Well, I've spent a lot of time in Russia and China. They're not stupid. They're chess players. They're Confucians. They look ahead and they see something coming that most people don't. So now you have this permissioned cryptocurrency called a Putin coin or a Xi coin, backed by gold, and then they let in who would come in? Well, Iran, Turkey, North Korea, Syria, maybe Venezuela, and then maybe some bigger countries would want to join in, Brazil, India, and others. And you create a trading network. And so Iran sells oil to China. China sells infrastructure to Russia. Russia sells natural gas to China. And North Korea sells weapons to Iran. Everyone takes a vacation in Turkey. All of a sudden, you've got a nice trading network going on.
The United States is not included there.
The U.S. is not. There's no dollar in what I just described.
Yeah.
So all of a sudden, your dollar sanctions don't work. Your account freezes don't work. It strips the U.S. of one of its most powerful military weapons, which is financial warfare, and sets these countries on a non-dollar path. That's already happening. That's not science fiction. Everything I just described is already happening. But the question is, people don't see it coming, but that could emerge very quickly. So you could have a collapse. You could have SDRs from the IMF. You could have a Geithner's remedy, which I talk about in my book. There are a number of paths, but they all involve reducing the role and value of the dollar.
There are just so many macro themes that you're describing here. And I've got to tell you, I did quite a bit of learning in the book. And if you come in with a pretty bullish mind about you, you might see the author, Jim Rickards here, making some pretty good thought-provoking points in his book that'll get you thinking in different ways. But so many scenarios unfold in which we will have substantial inflation and the dollar loses value. And I know in your book's conclusion, you say that hard assets and hard work are the only stores of value. Stocks and bonds will be worthless because those companies will collapse and the nominal value of whatever is left will be wiped out by this inflation.
That's a big picture scenario, but it's basically correct. So look, stocks aren't going to go to zero. But remember, in the Great Depression, they went down 80%. In 1987, they went down 22% in a single day. And the NASDAQ wiped out. The NASDAQ dropped 80%. So these things do happen. But things that sort of power through are gold, silver, fine art, real estate, natural resources, oil, natural gas, hard assets of various kinds. You got to be careful about leverage. Leverage works fine in a stable environment or an inflationary environment, but it can come back and bite you in a deflationary environment.
Yeah, so it's got to be secured with cash flow monthly.
Yep, just be careful about that. But absolutely, I recommend real estate as one of the model assets for this portfolio.
Well, Jim, it's certainly a thought-provoking, provocative, and eye-opening book. Can one buy Aftermath in all the usual places?
Yes, and it's the official publication date is July 23rd, but you can order it right now on Amazon, Barnes & Noble, Pals, and other independent and other online resources. So I hope people get it, and I hope they enjoy it.
Jim Rickards, it's been stimulating. Thanks so much for coming on to Get Rich Education.
Thank you.
Yeah, a lot of thought-provoking material from Jim Rickards there. So Jim is not a fan of cryptocurrencies. Many nations are increasing their gold reserves. Russia and China more than tripled theirs in the last 10 years. And hoarding gold is obviously a sign that one feels bearish and uncertain about the economy and the monetary system. He thinks that if you're positioned in real assets like oil and gas, fine art, and real estate, that you should fare pretty well in a global reset. We talked about GDP growth a good bit, and by the way, there was a recent release of data from the Bureau of Economic Analysis that showed year-over-year GDP growth by U.S. state that you might find interesting. The bottom 3 states for growth are Alaska, Wyoming, and Delaware. They all had close to 0 GDP growth. The top 10 states for growth, let's count them down, these fast-growing states, were number 10, Texas, with a 3.2% year-over-year GDP growth. Number 9 was Nevada, also at 3.2. Then going up the list toward number 1, you have Oregon, Colorado, California, Florida. Here at Florida, you're up to number 5 with 3.5% GDP growth. 4th was Arizona with 4% GDP growth. And then Idaho at 4.1, Utah at 4.3, and the number 1 state by far for GDP growth year over year with 5.7% GDP growth is Washington State. Yep, led by information services growth, as you might have guessed. A lot of Western states there in that list. Jim Rickards' book, Aftermath, will teach you a lot about history, how the global economy works, and why threats to the global economy really are threats. So it's a really informative book. And a lot of times while reading it, I kept telling myself, that is a great point, and I've never thought about that before. This book really connects the dots. And if you're an economic student, you'll find that Aftermath, it's kind of in a nice sweet spot where it's not over your head, but at the same time, it stretches your thinking. So it's really a great vehicle for learning. I'm Keith Weinhold, and I'll faithfully return next week to help you build your wealth. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.